Will Treasury yields go back up again or keep falling? And should you buy Treasuries at auction this coming week? Hello, members, super savers, and bond course fans. I hope you're healthy and well. What a week it's been for inflation and bonds. Here are the 3 topics that we'll be covering in this week's Treasury update video. What happened this week with the CPI report and at the FOMC meeting? Where did bond yields end this past week? Plus, what's on the upcoming auction schedule? And what are the yield expectations for some of these auctions? And in this section, I'll also talk about my take on whether Treasury yields will go back up again or keep falling, and whether I personally would buy at the upcoming week's auctions. 2 questions that we've gotten quite often this past week. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. As many of you already know, the inflation readings released this past week by the Bureau of Labor Statistics, the BLS, showed that the Consumer Price Index for all urban consumers, CPIU, was unchanged in May. Over the last 12 months, the All Items Index increased 3.3% before seasonal adjustment. These numbers were below market expectations. Core inflation, which excludes more volatile food and energy prices, also came in below market expectations, with the smallest monthly gains since 2021, increasing 0.2% month over month and 3.4% year over year. While this was good news for inflation, it didn't change the result of the FOMC meeting that took place the same day that the CPI numbers were released. The Fed left rates unchanged, and they also updated their forecast to include just 1 interest rate cut this year and 4 in 2025. Remember, the Fed had initially forecasted 3 rate cuts for this year. So by reducing the number of forecasted rate cuts for 2024 from 3 to just 1, the Fed has essentially pushed out some of the interest rate cuts that were initially planned for this year to next year. In the words of Chair Powell, "We need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. Well, some of that good data came the following day. First, the BLS reported that PPI, the Producer Price Index, had unexpectedly declined in May, coming in 0.2% lower than in April, where CPI measures consumer prices, PPI measures wholesale prices. Second, the Labor Department reported that U.S. initial jobless claims reached 242,000 last week, the highest level in 10 months. More evidence of cooling inflation, as well as an indication of a slowing economy, did what they were supposed to do and pushed bond yields down this past week. Let's move on now to the next section of this video to see how significant this drop was. As we so often do at the end of a week, let's compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. With the exception of the 1-month and 2-month maturities, which remain unchanged, bond yields were pretty much down across the board this past week, as you can see here. Relative to the beginning of 2024, though, bond yields are nearly all still up, as you can see from this table comparing Treasury yields from this past Friday versus January 2nd. This row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black, and decreases in rates are shown in red. The 1-month and 2-month maturities continue to be down, but otherwise rates remain higher overall across all the other maturities. But, and it's a significant but, the past week alone wiped out about 50% or more of the gains in bond yields this year for maturities 3-year and longer. This development can be taken as good news and as bad news. The good news first. Those of you in our community who purchased medium and longer term maturities when yields were higher are now showing some paper gains if you haven't sold those bonds yet. And now the bad news. If you were buying bonds last week, and especially towards the end of the week, you would have likely gotten lower yields than the week before. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Resource Center website here. All sources are linked below in the first pinned comment. So, that was a recap of bond yields from last week. Now, let's take a look at the upcoming week's auctions and whether I personally would buy at them. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. And if we scroll down further, we can see the 19-year 11-month T-bond and 4-year 10-month TIPS will be auctioned off as well this upcoming week. Both of these are reopening auctions, so we already know what the coupons will be on those. At the time of this taping, here's what the coupon and the expected yield are for the 19-year 11-month T-bond. And here's what the coupon and the expected yield are for the 4-year and 10-month TIPS on Fidelity's platform. Do keep in mind that these two expected yield numbers can and usually do change all the way up to the time of the auction. Which brings us back to the questions from the very beginning of this video. Will Treasury yields go back up again or keep falling? And should you buy Treasuries at auction this coming week? So, as I've shared with many of our Diamond NestEgg regulars, bond prices on the secondary market are not always stable day to day, as you can see from this chart comparing the secondary market price of the 10-year T-note versus the S&P 500 over time. The yellow line represents the S&P 500, and the red line represents the 10-year T-note. Bond masters, folks, please refer back to Module 1 for a refresher on bond price volatility and where the stability and predictability in bonds lie. And as I mentioned earlier, when we went through this bond yield comparison table, in just the past week alone, cooler than expected inflation and labor reports wiped out about half or more of the gains in bond yields this year for maturities 3 years and longer. Well, imagine what a hotter than expected inflation and a jobs report could do to push bond yields back up. And in fact, a hotter than expected jobs report was what we had talked about in last week's video. And that hotter than expected jobs report did push bond yields up quite a bit the week those numbers were released. Now, I'm not saying bond yields will go back up again next week or even next month. No one can honestly tell you that, not even the Fed, as we've seen. They've also changed courses and projections many times post-COVID based on evolving data points. What I am saying is that I continue to believe that bond yields overall will go up again, just not in a linear manner. And as I've just shown you with the chart about volatility in secondary bond markets, bond yields and prices can fluctuate quite a bit in the short term. So I'm sticking to my long-term guns, so to speak, and will repeat what I've been saying since last year. The fundamental drivers behind rising bond yields have not gone away. Namely, our government's record-setting debt issuance levels, the rise in debt service payments, and our growing budget deficit. And I don't see that necessarily changing after a presidential election in November either. So, where does this leave us with the upcoming week's auctions, right? Many in our community know that I currently own mostly very short-dated T-bills in my bond portfolio. But for those in a certain age and stage of life, I am also a fan of dollar cost averaging into longer dated maturities, especially when buying at auction. For longer maturities, buying in increments over time can diversify your purchase price risk. Having said that, even if I were dollar cost averaging into longer dated maturities at this point, I would probably not participate in the upcoming week's auctions based on the current data and environment. This Morningstar article sums things up pretty well. Treasury yields see biggest 2 and 3 week declines since December as bonds keep rallying. And what can come down that quickly may possibly also go back up again, maybe even at a similar speed, I would think. But that's me. As I always say, everyone's financial journey is different. If you think this is it for bond yields, that it's all downhill from here, then you may end up taking a different course of action and lock in the current rates before they potentially decline even more. And if you want to continue the discussion and compare notes with me and others in our community, then join us in one of our live sessions in June. Our live YouTube member Q&A will be tomorrow, June 17th at 5:45 p.m. Eastern Time, with highlights of the upcoming 5-year tips and 20-year T-bond options. And of course, I'll also be talking a bit more about my thoughts on dollar cost averaging into bonds versus locking in the rates now. And our live Bond Masters course session will be on Monday, June 24th at 5:45 p.m. Eastern Time, with highlights of the 2-year, 5-year, and 7-year T-note auctions. The replays will be available afterwards, as usual, in the respective member and course areas. So, I hope you enjoyed this video and learned something new. And if you did and want a deep dive into how to invest in bonds and build a bond portfolio while yields are still attractive, then check out this video here on our 2 recently launched bond courses. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. All right, members, Super Savers, and bond course fans, good luck to everyone who's planning on buying at the upcoming week's auctions. And see you again very soon with more brand new wealth building content for your financial journey.